This presentation is an introduction to a fascinating world of forwards, futures, and swap contracts and are part of a larger space called derivatives. Derivatives derive their value, payoffs, and profits from another asset, and that asset is sometimes called an underlying. An underlying could also be a bond, and so a derivative can change value because interest rates change. And since interest rates determine bond prices and bond prices determine interest rates, some people refer to the interest rate as the underlying. Expressing the underlying as an interest rate is convenient because most bond quotes are in terms of yields, not prices. It's bond yields that are discussed in the financial news, and it's generally not bond prices. Okay, so now we're clear on what an underlying can be. Let's talk about the uses of derivative contracts. Derivative contracts can be used for speculative and hedging purposes, but our primary concern here is with hedging. Hedging means to reduce a pre-existing risk or a risk that's inherent in a future transaction. We will also discuss a recently created interest rate called SOFR. SOFR stands for Secured Overnight Lending Rate, and how derivative contracts that reference SOFR work to hedge risk. SOFR replaced LIBOR, the London International Bank Offering Rate, that was used for decades in the derivatives markets as a reference interest rate. LIBOR turned out to be easily manipulated, and because of fraudulent behavior on the part of some banks in London, a scandal unfolded that rocked the financial markets, helping to cause a financial crisis during the Great Recession. Okay, so now let's talk about forward contracts. A forward contract is an agreement between two counterparties, a buyer and a seller, to exchange a commodity or financial instrument, the underlying, for an amount of cash on a prearranged date in the future. They are negotiated bilateral trades, bilateral meaning between just two parties. Futures contracts, on the other hand, trade on exchanges, and so when they trade on exchanges, they facilitate speed and volume of transacting. And to do that, they're standardized. What does a standardized future contract mean? Well, it means that the size of the contracts are standardized. For example, 5,000 bushels of wheat is a standard contract, or 5,000 bushels of corn. In the wheat example, it could be red hard winter wheat. And for a corn contract, it might be number 2 yellow corn, and it has to be inspected so it has a certain quality. And then there are well-established maturity dates. All of those things are standardized so that traders know exactly what they're getting into, and they can very quickly make transactions. We won't discuss futures much here, but the important point is that for hedging purposes, there's not much difference between forwards and futures contracts. With a forward contract, no money or underlying cash changes hands when they're first entered. So you enter a contract today by agreeing that you'll transact in the future. When the transaction takes place in the future, that's when the contracts settle. Settlement takes place when the cash and the underlying asset changes hands. And so that's going to happen in the future. So other than some small margin requirements to make sure that both parties are serious about fulfilling their obligations within the transaction, there's no cash up front. You just agree, which is why you just agree to a transaction, which is why I'm often saying you enter into a forward contract. You haven't actually purchased the contract, because purchasing the contract means it's a cost to it. There's no cost to enter it. You just enter into an agreement to transact in the future at a certain price. There's no price today because the value of a forward contract is zero when you first transact, because the value of what you expect to pay in the future is the value of what you expect to receive in the future. So it really has no value at this moment when you enter the transaction, when you enter the contract. So let's look at a forward example so we have a better understanding of how these things mechanically work. So let's assume today is March 21st, and Kellogg's, a large cereal maker, and a large farm agree, with the help of a financial institution, that Kellogg's will buy 9,500 bushels of corn from the farm on August 4th for $8 a bushel. The value of that contract is zero at this moment No cash changes hands. Both Kellogg's and the farmer expect the price of wheat to be $8. And so the farmer is going to receive $8, and Kellogg's is going to give up $8 per bushel on August 4th. Now let's assume it's August 4th when the contract matures. If the price of corn turns out to be $9 a bushel, Kellogg's will have reduced its cost by $1 a bushel. So $1 times 9,500 bushels means Kellogg's just reduced its cost by $9,500. In that case, Kellogg's can maintain a stable retail price for its cereal by not having to worry about price risk. Now, an interesting aspect of forward contracts is that while many of the forward contracts settle with physical delivery, there's an actual delivery, in this case of corn, from one party to another, they often settle for in cash only, which means if this was a forward contract that settled only in cash, the farm would simply pay Kellogg's $9,500 for settling that forward contract. So you see, there's a winner and there's a loser associated with forward contracts. Now, what was the motivation for the farmer in this transaction? The farmer wanted to lock in a selling price. And in this case, they locked in a selling price of $8 a bushel. The price of corn could have easily fallen from March 21st to August 4th, well below $8, and that's what the farmer was at risk. The farmer was at risk of having to sell their product, their goods, at a low price. So when parties enter a forward rate contract, one party hopes the asset price goes up, the underlying goes up, and another party hopes it goes down. That's the nature of forward contracts, because there's a buyer, there's a seller, there's one that hopes the underlying price goes up, there's one that hopes the underlying price goes down. That should be no surprise to you because, for example, when you buy a stock, the buyer thinks the stock's going to go up, the seller thinks the stock is going to go down. If you buy a bond, the buyer thinks the bond price is going to go up, the seller thinks the bond price is going to go down. That's the way financial transactions work. As I mentioned in the introduction, SOFR is an interest rate. Many interest rate derivatives, including swap contracts, use SOFR as a reference rate. I'll discuss what a reference rate is in a minute, but for now, just realize that SOFR is a very short-term interest rate associated with borrowing and lending overnight. Yeah, really short-term, using treasury securities as collateral. Since this lending is collateralized with treasuries, which are considered risk-free, in other words, default-free, the interest rate is considered risk-free. SOFR rates move up and down with many other short-term interest rates in the economy, such as money market interest rates. Many types of financial institutions are involved in the SOFR market. For example, dealers post bid and ask prices, in other words, prices they are willing to buy and at which they're willing to sell at, respectively. Their buying and selling depends on their customers' needs, much like an auto dealer. When you're a broker-dealer of securities, you post bid and ask prices so your customers can see them, and then you specify the quantity security that you want to sell at that price. A security dealer may buy and sell hundreds of times a day, and these transactions must be financed. And not only that, but on the other side of the market is a securities dealer that just sold a security and now has excess cash that must be invested to earn a rate of return for the dealer. If the dealer doesn't invest excess cash balances for a return, it can't really be competitive with razor-thin margins. So what I'm saying is there's a strong motivation on both sides of the market as SOFR. There's somebody that wants to borrow money and is willing to pay an interest rate, and there's somebody with excess money that wants to earn an interest rate. So these are some motivations, among many, for the very short-term interest rate SOFR. Secured overnight funding rate. Now let's get back to reference rates. What's a reference rate and how does SOFR act as a reference rate? Let's take a step back and use two examples that you're more likely to be familiar with. Adjustable rate mortgages and variable rate loans in general. Both of these types of loans are linked or indexed to a specific well-known interest rate, so it's easy to verify. The cost of borrowing in these examples will depend on the future level of the reference rate, which is unknown when you first borrow the money. Therefore, applied to forward contracts, a forward contract exchanges a predetermined fixed rate for this unknown future reference rate. adjusted, of course, for the dollar amount and the time period covered by the contract. As always, an example will help in understanding these contracts. So instead of looking at a securities dealer, let's look at a bank and how it might use a forward rate contract. Suppose a bank has a customer that wants to borrow $1 million for 6 months starting 90 days from now. The bank today agrees to lend $1 million at 5% starting in 90 days. The bank wants to maintain a healthy spread over its cost of borrowing to remain profitable. Now suppose that the bank's cost of short-term funds is highly correlated with SOFR. But obviously the bank doesn't know where the cost of funds will be over that 6-month period starting 90 days from now. Consequently, the bank enters into a SOFR forward rate contract to hedge its interest rate risk by agreeing to pay 3% for whatever the actual SOFR rate turns out to be for the 6-month loan period. So in other words, the bank is going to be paying 3% and it's going to be receiving the average overnight secured funding rate over that 6-month period. Now the question becomes, what will be the bank's profit or loss on the forward contract and overall, meaning the loan and the forward contract, if SOFR interest rates average 6.2% for the 6-month period. Let me move over to a blank screen so I can compute the answers to these questions. So the questions are, what is the profit or loss on the forward rate agreement? And what was the impact of those higher interest rates on the loan? So let's figure out the forward rate agreement first. The bank has agreed to pay 3% on that forward rate agreement. And it turns out that the interest rate during the period starting 90 days from now and ending 6 months later is 6.2%. So the difference is 3.2% is the difference in the rates. We adjust for the semi-annual period, roughly 1/2. A lot of the calculations take 180 days divided by 360 days, various day conventions, which you don't have to know. I'm just going to assume it's 1/2. It's pretty good approximation. And then I'll go to multiply it by $1 million because that's the size of the forward contract. So therefore, the bank earned $16,000 on the forward rate agreement. That's what it's worth. That's what the profit is. And that's what the value of that forward rate agreement is at the end of that 6-month period. Keep in mind that the value of the forward rate agreement at the time the agreement was entered was 0. Because let's draw a timeline here. Here's time 0, which is today. It's usually how we draw these timelines. Today is time 0. 90 days from now is when the loan's extended for 6 months. So it ends in 270 days. So the bank is paying 3% on that forward rate agreement. And that's roughly its borrowing costs, its expected borrowing costs 90 days from now for this period. And so if this was the expected cost of borrowing, and that's where interest rates are expected to be in the future, then that's how this forward rate agreement was set right here at 3%. That was the forward rate 3% because that was the interest rate expected by both parties. So the bank entered into a forward agreement with another party. Both parties agreed that it would be 3% because that's the 3% that's going to be exchanged. So the bank pays that 3%. And since interest rates went up, they went up 3.2% in total, up to 6.2%. Then the bank had a gain of $16,000. But when it entered the contract, it expected to get 3%. It's paying 3%. So the value of the contract when it was first entered right here at time 0 is worth $0. Now, what was the impact on the loan side? Well, interest rates rose 3.2% in total in this example. They went from 3% to 6.2%, which means that's the cost of funds are higher by 3.2%. Therefore, the bank is earning 5% on the loan. But now, since rates went up 3.2%, the interest rate it should have lent, if it waited 90 days, should have went and been 8.2% times 1/2 for a semi-annual period of 6 months times the $1 million, and there you have it also. This is the loss of $16,000. So the gain on the forward rate agreement offsets the higher costs of lending, which reduced the profitability of the bank at 16%, at $16,000. Therefore, in this simple example, the bank completely hedged its interest rate risk that came about through agreeing to lend at a fixed rate in advance, or what we call lending forward. Now let's turn our attention to swaps, but before we do that, let's compare them to the forward contracts. Forward contracts, like the one we just looked at, are one-time transactions. Swaps, on the other hand, are a series of forwards. At least that's how you can think of them, as a series of forward rate agreements. We will cover interest rate swaps and credit default swaps in this video. This space is wide and deep, and we'll cover the very basics to get the intuition behind them. If you want a deeper understanding of swaps and forwards and futures, take a course in financial engineering. Financial engineering is cool because it allows you to construct nearly any risk and return scenario possible given the constraints of the market. Let's move on. It's probably best to cover an example of a swap to explain how they work. So let's look at an example where a swap transforms floating rate debt into fixed rate debt. So here it is. Suppose Apple, sometime in the recent past, issued 10-year variable rate debt at a cost of floating plus 0.1%, but is now concerned that interest rates might rise soon. Now notice, before we go any further, I just specified a floating rate. Didn't say, what exactly the floating rate is. Could be SOFR, could be another floating interest rate, like say a short-term treasury bill rate. But let's just leave it at floating. The loan principal is $100 million. To reduce its exposure to rising interest rates, Apple enters into a receive floating, pay fixed at 3% swap with Citigroup. The 3% represents the market's expectations for the floating rate over the life of the swap. Here we have the flow chart for the cash flows. You have Citibank on the left, you have Apple on the right. So it's common to use arrows to show the direction of where the money is going. And so you can see that at the top there, 3% is going from Apple to Citigroup. And Citigroup is paying the floating. That is the swap. Right here, this is the swap. And then right here, we have Apple's payment to its bondholders at the floating rate plus 0.1%. Let me point something out before we go any further. Look at the floating rate going into Apple, and then the floating rate exiting Apple plus a 0.1% fixed component. Those two cash flows net out so that there's a fixed cost of 0.1% involved in this transaction, along with the 3% that Apple will be paying. Now suppose that during one of the semi-annual periods, and this swap pays semi-annually, the floating rate turns out to be 5%. What is Apple's overall cost of debt? So let's work it out on this slide. I put the flow chart at the top so it's easier to keep track of things. So according to the problem, the floating rate is 5%, and that applies here and also to here. We just look at the swap. What we see is, from Apple's perspective, Apple is receiving the floating of 5%. It's paying 3%, so it's making 2% on the swap. And then it has to contend with this side. This is the payments to its bondholders. And so Apple is making payments minus 5.1, the total of 5 plus the 0.1% there. And this is the cost of debt. And so the sum here is going to be 3.1% is the cost of debt, what I'll call overall. The sum of the swap plus the debt outstanding. Had Apple not hedged its risk here, it would have paid 5.1%, just for this semi-annual period. So Apple correctly predicted the direction of interest rates and acted accordingly by paying a fixed rate and receiving a floating rate using a swap and offset some of the increased cost of their floating rate debt. And they locked in a fixed rate of 3.1% overall. Now notice what's happened in this situation. This is really interesting. Because of the swap, Apple did not have to change its capital structure. What do I mean by that? Well, companies have a certain amount of debt, and they have equity that is used to fund their assets on their balance sheet. Capital structure says, what's the percentage of debt and what's the percentage of equity? It can vary quite a lot between businesses and even in businesses in the same industry. What's at issue with capital structure are things like, what is the optimal debt to equity ratio to control the level of risk of the firm? Too much debt leads to a highly risky firm, whereas too much equity means the firm is missing out on the tax advantages from debt, such as deducting interest expense. And then there's issues around dividend payout policies versus retention of retained earnings to grow the business. Should the company pay a dividend and then borrow money, or should it reduce its dividend so it doesn't have to borrow money? Another capital structure issue is how much of your debt has a floating interest rate and how much of it is fixed. These are all issues around capital structure. Now, getting back to Apple's capital structure, it left its debt unchanged, left its equity unchanged, and just overlaid on top of this a derivative contract which changed its variable rate cost to a fixed rate cost in this case. My point here is that in order for Apple to change its capital structure from floating to fixed interest payments, would require Apple to buy back its floating rate debt and issue fixed rate debt. That would cost millions of dollars in debt restructuring costs, such as investment banking fees. Instead of doing that, it entered into an interest rate swap, like I just showed you, that cost nothing at inception, just like how a forward rate contract costs nothing at its inception. That's because the swap's fixed rate equals the expected floating rate in the future over the life of the swap. Now, keep in mind a couple of points. One is we just used a plain vanilla interest rate swap. It's about as simple as a swap comes. There are many, many different flavors or variety of swap contracts. This is the simplest because what we're doing is we're swapping a fixed for a variable rate. That's what a plain vanilla interest rate swap does. And there's many variations on how it works. And those variations are called flavors in general. For example, you could swap a floating rate for a floating rate. That's right, two different reference rates. One side of the swap is hoping that the two interest rates move together later on during the life of the swap, and the other party hopes that the two interest rates pull apart over the life of the swap in order for them to make money. The other thing you want to keep in mind is when we were analyzing this particular swap, we were just analyzing one period. Remember, a swap is a multi-period instrument. So this could go on for a number of semi-annual periods and where the interest rate changes, and so the payments are going to change every period. Another type of swap is a credit default swap, known as CDSs. We want to cover these in more detail as they represent a recurring topic in this course. Credit default swaps are a form of credit insurance for a bond or a loan of an issuer, referred to as a reference entity. The reference entity may be a company, municipality, or even a country. The buyer of a credit default swap pays an insurance premium, known as a spread, every quarter, and in return gets a one-time payoff if the reference entity experiences a credit event such as a bankruptcy or credit rating downgrade. The insurance premium is called a spread because if the buyer owns the underlying bond plus owns a CDS, the credit default swap, and pays that spread, the bond or loan in effect becomes a risk-free asset that earns the risk-free rate. Let me show you the math. Let's suppose you own a fairly risky bond, which is why you bought credit insurance in the first place. So you have a bond yield that's fairly high, let's say 7%. And then if you buy a credit default swap, you're paying a spread or insurance premium. And so that's going to reduce your return. Let's say it reduces your return by 3%, because that's the spread. So I'll label this CDS spread. That spread reflects the risk of this bond. And so when you get done with this difference of 4% should be the risk-free rate. Because you've now turned this risky bond into something that has no credit risk. And so you should earn the risk-free rate of 4%. So you can rearrange this as saying bond yield equals the risk-free rate plus the spread, the CDS spread. And so that's one way to think about how a credit default swap works. It transforms a risky bond into a risk-free bond, or a risky loan into a risk-free loan. And so you have a common equation now, common relationship that you see in finance. A bond yield, a risky bond yield, is composed of a risk-free rate, which considers the opportunity cost of money, and then a payment for risk. Now there are several caveats that I want to mention about this relationship, because it's an approximation in the real world. First, the exact relationship depends on the liquidity of the underlying bond and the CDS. The more liquid the two instruments, the closer the relationship I just presented will be. Second, the relationship depends on the credit default swap seller's credit standing. In other words, when you buy a credit default swap in the over-the-counter market, where the two parties are transacting between themselves and there's no central counterparty, which I'll discuss in a minute, the CDS buyer, the credit default swap buyer, could be substituting the credit default swap seller's credit standing for the reference entity's credit standing. In other words, the credit default swap seller could default on the credit default swap when the reference entity defaults. This is known as a double whammy. Don't think it can't happen. It did in the Great Recession, when credit default swap sellers sold way more credit default swap insurance than they could handle because of the seemingly high profits. When the credit default swaps reference entities were financial institutions, they defaulted, which caused the credit default swap sellers to default, and we had a financial catastrophe. CDSs are a convenient way to take a short position in a bond, or in some cases a bond index, like a basket of bonds. Let me back up a minute and talk about short selling. While short selling is relatively easy for stocks, it's kind of difficult for bonds. Short selling involves borrowing a security, selling it with the intent of buying it back at a lower price and returning the asset to its owner. It's a way of making money when asset prices fall. When you borrow an asset like a stock or a bond from someone with the help of a broker and sell it to a third party, you need to pay the owner the dividends on the stock or the coupon payments to the bonds over the time the asset is borrowed. For bonds, this can be expensive and is usually not done, as coupon payments could pile up. An alternative way to make money on falling bond prices is by buying CDSs, credit default swaps. Let's look at the cleanest type of example we can have. Assume a CDS insures an entity with bonds outstanding. A CDS buyer owns one such bond worth $1,000. The bonds are investment grade and the premium on the CDS is 1% per year, or $5 every 6 months for insuring the bond. Now assume the reference entity experiences, quote, a credit event, unquote, and the bond is now worthless. And again, the credit event could be a downgrading, for example, of the company or the company going bankrupt. Now, when the reference entity experiences the credit event, the CDS seller, basically the insurance company, so to speak, will be required to pay $1,000 to the CDS holder, and the CDS terminates. The swap terminates. Now that we know what a CDS is, let's focus on how They nearly collapsed the world's financial markets and in turn the economy. This is a two-part story. That helps explain what a central counterparty is that I mentioned a few minutes ago. Part one is the overissuance of credit default swaps, and part two has to do with there was no central recording or record keeping going on. So nobody really knew what was going on a macro level. How can the lack of centralized bookkeeping cause problems? Well, so many CDSs were issued that when the underlying entity collapsed, the insurer, in other words, the financial institution that issued the CDSs, failed. It's like a property insurance company issuing all of its insurance along the San Andreas Fault in California and an earthquake hits. The insurance company's going to go bankrupt paying everything off. So basically, you need an insurance company that diversifies and insures property across the United States to hedge its risk. Now, Dodd-Frank changed all this after the Great Recession by standardizing CDSs and forcing them to be cleared and processed through centralized clearinghouses. Let me back up and explain. Every financial transaction that has a trade date, it's the date the buyers and sellers agree to a transaction and they're basically matched. A broker helps match the buyer and seller, and a price is agreed upon. That's transaction date. And there's also a settlement date. Settlement date is when the actual securities and the cash changes hands. It's usually a few days after the trade date. So that's some important information to know. Now, what's also important to know is that clearing a trade means processing a financial transaction from the trade date to the settlement date, including record keeping. Now, let me introduce two entities involved in this process that sound very similar but are different. The first is a central clearinghouse, which clears all trades and is in a position to know the total amount of outstanding securities on an entity and in the overall economy. The second is a central counterparty. The central counterparty is common nowadays in the derivatives markets. It stands in between the buyer and seller so that each party transacts with the centralized clearing party rather than with each other. Therefore, if a buyer or a seller fails to fulfill their end of the swap, the central counterparty fulfills the transaction. The central counterparty basically collects a fee from every single transaction that takes place, and that's how it gets funded. It helps for a very smooth market so that buyers and sellers don't have to worry about the counterparty failing. By having a centralized clearing party, if one party to a CDS fails to fulfill their end of the transaction, the centralized clearing party makes sure the transaction is covered, so no counterparty risk and the derivatives markets work smoothly. Yeah, that's right. I'm happy to report that after the financial markets and the economy almost collapsed, due in part to the credit default swap market during the Great Recession of 2007-2008, the financial community, with a strong push from Congress, with the help of the Dodd-Frank Act, cleaned up the swap market by requiring central clearinghouses and central counterparties. And things ever since have been relatively stable. But not so fast. You notice what happened. What we now have done is we've taken all that credit risk and aggregated it into the central counterparty. In other words, now we have a giant systemic risk because if that central counterparty fails, then the whole system collapses. The entire swap market knows this and have created a number of checks and balances so that the central counterparty doesn't collapse. But as you know, after studying the material in this course, nothing's bulletproof.